what would you like to see the Fed do at subsequent meetings? Because there is still some bets out there in the marketplace, Dave, that we could get back to a rate cut territory, which was kind of off the table for a bit, at least in February and earlier this month. But give me your sense on what you would like to see the Fed do past this meeting, and what you think the Fed will do past this meeting.
Okay, well, I think that the Fed is ultimately going to find themselves in this time frame of pivot and pause. I'd like to see them pivot and pause. In fact, I would have liked to see them act a little bit earlier than March last year, and then we would have had a slower approach to this. But we've ultimately hiked these rates so fast, so high, that we're in this sort of unique place. We've never seen the outlook or the outcome of what's going to be going on from here. So also a lot of the data that the Fed's looking at is just in the rearview mirror. And so if we're looking in the rearview mirror and not through the windshield, that's just kind of a weird way to be driving the car. So what's the Fed going to be doing? I think that they're going to be evaluating things. They're going to be looking at it. They're obviously well equipped to be intervening here when challenges do show up. But what happens when we have Chapter 11s that begin to happen because these organizations and institutions cannot metabolize the debt that they need to because they're growth companies and it takes more capital to run them than they actually make, or the commercial real estate industry is no longer able to get loans. At least we're going to see margin compression, and so expect probably an earnings recession here within the next month or two as earnings come up here in April. But it'd be nice if the Fed would ultimately be communicating with the Biden administration about supply side economics. They just affect demand. What if we could, increase supply, and we find the buoyancy of what the market and capital markets would ultimately want to be at. But we're a long way off from 2%. So I would love for the Fed to say 2% is our target, but not necessarily a mandate. When they declare that it's a mandate, though, we have just different outcomes and different ways that the Fed is going to be moving forward with these ideas.
Lastly here, let me ask you about U.S. home sales. This morning we saw that figure jump 14.5%, Dave. That marks the largest monthly increase since July of 2020. What does this tell you right now about the state of the housing market?
Well, the housing market this time of year tends to become a little bit more active. People have gone through the winter. They're now looking to relocate, and so more homes go on the market right now. So those who have capital and are ready to deploy it, guess what? This is a great time. And I'd say that we're in a buyer's market for real estate today. But where are the buyers really? 50% of America refinanced their mortgages in 2020 and 2021. 50%. And so the mortgage industry, saw record lows last year as far as applications go and refinances. As we look at just the understanding of interest rates today, when we increase 4% within 1 year, every 1% that those rates go up either takes 10% more income to buy at last year's price, or we just have to see the prices come down so significantly. I don't think that we've seen the true sense of what's going to happen here as credit gets tighter, as these the examples of what it takes to even get this credit and the length and the time of these loans is going to ultimately work out. I mean, if they created a 40-year mortgage right now, I'd say, yeah, we're game on again and things are going forward. But I don't really see it past a little bit blip on the radar here, given some demand pressure that's been built up.